Apollo dropping 3.7 billion on a Japanese glass maker was definitely not on my bingo card.
Really? A weak yen and a legacy industrial asset? That is textbook Apollo. I am way more shocked by Blackstone.
The cricket rumor.
Yes, a global cricket league? Are private equity guys just bored?
Or they finally ran the math on Indian media rights. Either way, between PE playing sports and SK Hynix dropping almost 8 billion on AI chip tools, the checkbooks are wide open today. The rundown.
$7.9 billion on equipment. Not a company, just the tools.
When you're SK Hynix and you need to dominate AI memory chips, you don't skimp on the ASML machines. It's an arms race, Maya.
I know, but almost $8 billion for EUV chip-making tools is wild. Analysts are calling it an aggressive but necessary play. I just look at the depreciation schedule on that hardware and wince.
Spoken like someone who never had to pitch a semiconductor deal. You have to spend the capex to catch the AI wave. If you wait, you're dead.
Fine, but I want to see the ROI timeline on those machines. Speaking of things I need to see to believe, Berkshire Hathaway just dropped $1.8 billion for a 2.49% stake in Tokio Marine.
Oh, I love this one. Warren's playing chess in Tokyo again, but this isn't just a passive value play. The word is they're going to collaborate on global M&A and reinsurance.
Wait, really? Collaborative M&A with Berkshire? I don't buy it. Berkshire doesn't collaborate. They buy you or they ignore you.
You're underestimating the Japanese market dynamics. Having a local titan like Tokio Marine as a wingman opens doors that a pure American checkbook just can't. It's a strategic pivot.
Call it a pivot if you want. I call it a very expensive networking fee.
We'll see who's right in 5 years. Moving from high finance to literal dirt, Veolia is spending 220 million Australian dollars on a soil remediation player down under.
The PFAS play. Forever chemicals are the new gold rush for waste management companies. Everyone's terrified of the liability, so if you have the tech to clean it up, you can name your price. That's actually smart.
Speaking of smart, Desjardins Group just closed their 1.67 billion Canadian dollar buyout of Guardian Capital,
Creating a $280 billion asset management platform. Massive scale play. But we need to hit the rumor mill quickly. Estee Lauder is apparently talking with Puig.
Smells like a deal.
Terrible joke. Also, Blackstone is supposedly evaluating a stake in a global cricket league.
Oh, come on. Blackstone doing cricket? Actually, sports assets are a non-correlated yield play. Plus, I'd pay good money to see the investment committee try to explain a wicket.
I demand the transcript of that meeting immediately. But speaking of massive private equity swings, we need to talk about Apollo.
$3.7 billion for Nippon Sheet Glass. Their biggest Japanese buyout ever. The big one. $3.7 billion for a glass maker. I love it. It's so phenomenally boring.
Boring is Apollo's love language, Nate.
Exactly. While everyone else is fighting a holy war over AI chips, Apollo is just casually writing their biggest Japanese private equity check ever for Nippon Sheet Glass.
I read the release 3 times looking for the catch. $3.7 billion is a massive flex. It's their largest PE venture in Japan to date. But you have to wonder if they're late to the party. Every major buyout shop has been treating Tokyo like a discount warehouse for the last 2 years.
I strongly disagree that they're late. They're just playing a different game. This isn't a distressed asset play. This is Apollo looking at Japanese manufacturing, seeing trapped value, and knowing they can engineer the capital structure better than anyone else. It's classic banker math, and I say that as a recovering banker.
Okay, but look at the actual asset. Glass is wildly capital intensive. The margins are constantly squeezed by energy costs. I'm not saying it's a bad deal, but I'm highly skeptical of this narrative that you can just walk into Japanese industrials, apply some New York leverage, and print money. The yen won't stay weak forever.
You don't think Apollo modeled the energy costs and the currency risk? Come on. They have an army of associates living in Excel for this exact reason.
I'm sure they did. I'm just saying the margin for error is thinner than people think. But what actually caught my eye wasn't the glass deal. It was the packaging play they slipped in right next to it.
The Syntegon stake?
Yes. Buying a 37% minority stake from CVC Capital Partners. That's a fascinating structure. CVC keeps control, Apollo gets exposure to a massive packaging platform, and they don't have to do the heavy lifting of a full buyout. It's so rare to see Apollo play second fiddle in a capital structure.
True, but think about the relationship dynamics there. CVC gets a partial liquidity event without giving up the keys, and Apollo gets to deploy a massive chunk of managed fund capital into a stable cash flowing business. It's a smart hedge. You get the glass maker outright in Japan and you take a passive cut of packaging. It's like they're building a portfolio of things you drop on the floor.
Things you drop on the floor?
Glass packages, you drop them.
That's a terrible analogy, and you should feel bad.
I thought it was pretty good. I was trying to find a common thread.
You failed, but the broader point is Apollo is clearly seeing a ceiling in US deals right now. The math is just better overseas, which, by the voices,
I am reading this analyst note on Berkshire Hathaway, and they're calling this $1.8 billion stake in Tokio Marine a strategic pivot toward collaborative global M&A.
a strategic pivot. It is Warren Buffett buying a 2.49% stake in a Japanese insurance company. That is the most Berkshire Hathaway thing I have ever heard. There is zero pivot happening here.
No, you are missing the wording. The collaborative M&A part. Berkshire usually buys the whole sandbox or just sits on the bench collecting dividends. Partnering up with Tokio Marine to co-hunt for global acquisitions, that is a distinctly different posture.
I will believe it when I see the actual joint term sheets. Half these analyst notes just dress up basic value investing with buzzwords to justify their subscription fees. Until they actually co-sponsor a deal, it is just Berkshire parking cash in a yield-friendly geography.
You are so cynical today.
I prefer data-driven. Now, if you want a genuinely aggressive play, look at what the industry watchers are saying about SK Hynix.
The ASML deal.
Exactly. Analysts are calling their $7.9 billion ASML equipment purchase a necessary play to secure dominance in AI memory chips.
$7.9 billion on tools. My dad used to complain about spending $300 at Home Depot.
Well, your dad was not trying to fabricate high bandwidth memory for NVIDIA GPUs.
True, but calling an equipment purchase a strategic play feels weird to me. It is just CapEx. Really, really expensive CapEx.
It is CapEx that functions like an M&A roll-up. If you buy up all the available extreme ultraviolet lithography machines from ASML, your competitors literally cannot build the chips. You are buying market share by starving the supply chain. It is a brilliant squeeze.
I guess if you spend $8 billion, you get to call it whatever you want. Speaking of throwing around massive checks in Japan, though,
Let me guess, we are talking about Apollo.
we absolutely are, and $3.7 billion for a glass company is just the start of their week. Spill the tea. I'm telling you, the drama on the high seas is better than reality television right now. Genco Shipping just officially stiff-armed that revised takeover offer from Diana Shipping.
Stiff-armed is putting it politely. They basically told them to take a long walk off a short pier. Diana's revised offer wasn't even a real premium. I read the filing. They just shuffled the cash-to-stock ratio and hoped the Genco board wouldn't do the math.
This is why shipping deals are my favorite. It's all ego and giant boats. But if we're talking ego, we have to talk about Estee Lauder finally confirming those whispers about Puig.
The European fragrance giant.
Exactly. It's a massive prestige play. Estee Lauder needs a spark, and adding Puig's portfolio gives them absolute dominance in high-end perfume. It's a gorgeous fit.
A gorgeous fit? Oh, come on, Nate. Estee Lauder's margins are getting squeezed. Buying a massive luxury brand right now is just acquiring expensive revenue to mask operational issues. They need to fix their supply chain, not buy more perfume.
Spoken like a true spreadsheet warrior. Sometimes you have to buy the shiny object to keep the market distracted. Speaking of shiny objects, Blackstone is reportedly evaluating a surprise stake in a global cricket league.
Wait, really? Cricket?
Yes, private equity has officially run out of American sports to buy. We're going to have John Gray out there explaining what a wicket is on the next earnings call.
That's actually incredible. Though live sports rights are one of the few places left with guaranteed captive audiences, it makes total sense for their alternative yield strategy.
I just want to see the pitch deck. I guarantee some first-year analyst had to build a slide defining how many overs are in a match.
Poor kid probably didn't sleep for a week. We'll keep an eye on the cricket pitch, but tomorrow we're watching biotech. Gilead Sciences is supposedly inches away from a $2 billion finish line with RO Medicines.
And for our deal makers in Southeast Asia, the Philippine Competition Commission just officially elevated their M&A reporting thresholds. The runway is clear for a whole new wave of mid-market deals. Tomorrow's radar. Keep your screens awake for Gilead tomorrow. I'm hearing they're inches away from finalizing that $2 billion buyout of Uro Medicines.
$2 billion for Uro? Come on, they only have one candidate barely out of phase 2. Gilead is just panic buying because their oncology pipeline is stalling.
Panic buying is harsh. It's a necessary bolt-on. You pay a premium for the asset you actually need.
You pay a premium when you have leverage. $2 billion for a single viable molecule is peak biotech desperation. What else are you tracking?
All right, try this. Blackstone is supposedly evaluating a surprise stake in a global cricket league.
Wait, really? Cricket?
Yep, private equity has officially run out of SaaS companies and discovered the pitch.
I can't wait to read the synergy models on Wicket sales.
We'll see if a term sheet actually drops tomorrow. Read your footnotes, people.